Are you like most sales and other professionals who want to grow their wealth faster than what they are currently doing through their company 401k, even with that company match, the stock market, or just plain saving money? Would you sleep better at night if you had the financial freedom to be job optional in just 3 to 5 years through investing in real assets? Maybe you don't want to stop working, but wouldn't it be cool if you could retire a decade earlier than most and do the traveling you and your family have planned for years while you're still young and can enjoy it? Let's face it, most busy professionals don't have the time or desire to take on more work outside of their W-2 to grow their wealth. On The Wealth Flow, each week we share the stories, the investments, and take a deep dive into the various asset classes that can deliver that accelerated growth to your portfolio passively. That's right, no extra work for you. Instead, we'll put your money to work. Learn what the 95% aren't talking about and join the top 5% of earners today on The Wealth Flow.
All right, welcome to The Wealth Flow. My guest today is Erik Nordstrom and Erik Strom with Iron Ridge Capital. They have over 18 years of experience in multifamily real estate syndications. Their firm has built a strong track record on delivering consistent, high-performing investment opportunities, averaging a 25.7% annual return to their investors over the last 18 years. They specialize in acquiring, operating, and optimizing multifamily and commercial properties across key markets. They are vertically integrated, and they not only own and operate their own portfolio, but they also provide third-party property management services as well. So, guys, I am looking forward to our conversation today. Welcome to The Wealth Flow.
Thanks, Keith. We're looking forward to it too.
Yeah. So I always love to start with, and I will say, we don't normally interview two guests at once, so this part may take a little bit of time to answer this particular question, but I always love to find out a little bit about, who we're talking to. What did you guys, where'd you grow up? What led you to this world of real estate investing?
Sure. I can kind of start to speak for a little bit of both of us, and then I'll let Erik kind of tell a little bit of his story. But Erik and I actually met each other in high school. So we met each other in a lunchroom cafeteria when we were 14. We became friends, had a great group of buddies that just got into all sorts of trouble together from, 14 up till, we still hang out, do golf trips together, and we've all gone on our own professional paths. As it relates to real estate, like most teenagers in the late 90s, early 2000s, I was reading Rich Dad, Poor Dad, and I just decided that I had to go out there and buy assets, and it got me going on all the books of how to buy money or houses, no money down, and I was running around in a rusted out S10 Blazer trying to buy stuff, and we truly didn't have any money. Erik and I did not grow up with trust funds or connections or country clubs. So, after a while, we realized, you really do need some money, and it helps. So I went to the University of Washington out in Washington State and started getting internships and just fell in with some great mentors, people that were brokers, people that were syndicators, guys that did everything from multifamily to office, retail, development, and bounced around and found some guys that were doing multifamily syndication. And I just said, you seem to be doing pretty good. Can you teach me what you do? So I started as a broker, did that for about 10 years. And during that time, I was investing and started syndicating after I had owned about 4 properties and learned a bunch of mistakes and had a bunch of failures that really taught me how to be a better investor and operator. And then in 2007, 2008, did our first syndications, and then Erik Nordstrom came back from Florida, and him and I started doing stuff together. And I'll give you a little bit of a chance to tell kind of how you got into this.
Yeah, after high school, went to college in Florida, and after college, I got into the fitness industry. I started opening up my own gym chains. Opened up about 4 with a couple partners, and Erik and I always stayed in contact. So I followed what he did in the real estate industry. And, um, I realized in the fitness industry, I've kind of hit a ceiling. You really had to scale up big time to kind of make money in the fitness industry. And so I started investing with him. And then we bought our first deal together in 2011, small 6 unit in downtown Seattle. And him and I and his dad swung the hammer on the entire project, inside and out. And, that was probably some of the most fun experiences I've ever had in it, just because, we didn't pay ourselves much. I think we paid ourselves $2,000 a month to renovate this property. But had a great experience, and, stayed with the fitness industry for another year and a half after that. And then just realized that real estate was the passion, and I wanted to work with, one of my best friends. And, so we kind of partnered up together later on, and history has kind of written itself from there.
Yeah. And that little 6 unit that we did together, I mean, we did everything. We demoed the units, we renovated them, we did all the property management on it. It was 6 units. It was really easy. But, this was also out of necessity. We were coming out of the Great Recession. I was used to making a ton of money as a broker. I'm in my 20s, making $300,000-$400,000 a year. And then all of a sudden 2008 hits and somebody just turned the faucet off. Nobody wants to buy real estate. Nobody wants to sell real estate. I've still got a BMW payment that I can't really, I don't have income coming in to make it. I'm watching this pile of money just dwindle down. And, by the time we had gotten to that 6 unit, I mean, we only had to raise $350,000, and I had $9,000 left in my bank account. I was living in a closet, had a little IKEA curtain over it. The closet was just big enough for a full-size mattress and a computer. And we drew the first Iron Ridge logo in that little closet. And, during that time, that scar tissue that we had from 2008, 2009, 2010, it really taught us a lot about how to be disciplined, how to underwrite properties well. Since we had to do everything ourselves, I wasn't going into an office every day with a suit on, trying to get people to buy and sell real estate. I was showing up to show units, plunge toilets, learn all the accounting that I had learned in college but never paid attention to, so that I could actually do tax returns for investors and things like that, because I couldn't afford to pay anybody. And, you come out of it, one, with more discipline and with a little bit of scar tissue, but two, you know how to do a little bit of everything. And I think it makes you such a more well-rounded investor. Now, after that 6 unit, we leveraged it into an 82 unit, then we did a 18 unit, then we did a 92 unit, and then we were off to the races. We had made enough money on those projects that we had a good track record, word was spreading, and, two broke kids from Renton, Washington had a network of people that were referring us more capital. And, we were very, we weren't trying to blow up the world. We'd do about 1 to 2 deals a year. And it grew organically from there.
Oh, that's fantastic. Yeah, it's not a good time to be in solely a real estate broker. I shared that with you, Erik. I was a real estate broker at that time, and I always describe it the same way. Like somebody just turned off my income like a faucet. It just was not an easy time, and but I do think going through that kind of helped prepare me, and I'm sure you feel the same with what just happened. It wasn't the same way by any means.
No.
Totally different. But it's funny how people still talk about it the same way. In some respect, coming out of it, people can't decide whether we're in a recession, whether it's not. And it's just I just remember that from '07, where it was like it took forever to kind of be like, okay, these people aren't feeling the same pain I'm feeling. It seems like they're sort of glossing over, what's really feels like it's going on in this market. So it's always, it's just interesting. And I kind of see some of the parallels as we kind of went through this last stage of just the huge rate hikes that happened. So.
Oh, totally. I mean, we were in Seattle, Washington. So all my buddies were in our, mid-late 20s. They're all working for Microsoft and Amazon, and they're going out on the weekends, and they're saying, "Hey, Erik, do you want to come out?" And I'm like, "I can't. I don't have any money." They're like, "Oh, we'll buy you a beer."
Yeah.
And it was a different time. But I mean, in that recession, I mean, as long as we thought that was, if you compare it to what's happened over the last 4 years, it was very different. I mean, there we had pain, and then we allowed that pain to kind of work its way through the system. We had some bailouts, sure, but this last one has been like the longest moving train wreck or slowest moving train wreck that we've ever seen. You keep wondering, okay, well, when's that inflection point when this new cycle starts? And I still am not convinced that we're right at the beginning. I think we're kind of past the majority of the pain. We're in that window of opportunity where you can find some really, really, really good projects and investments to buy, but you can also stumble and you can pick up some bad apples. So I think that we're going to start here as soon as we start to see, at least in the market we're in Texas, when we start to see, occupancies tighten and you see that first bit of rent growth, then that's going to mark the beginning of a new cycle. And I told my wife every day before I leave the house, go out and buy all the maybes. That's what you need to tell me when we hit that point.
Yeah, that's right.
I will say too, I mean, we are at that juncture where, all of last year, we knew that banks were wanting to take, we're going to be taking deals back. We tried very hard to get in contact with lenders, and that communication just wasn't happening. And then really this last probably 60 days, that has changed a ton. I mean, we've had probably 5 conversations with lenders in the last 2 months. We're actually under contract on a deal right now that the bank, the lender foreclosed on. We had an LOI signed immediately after that. And, we're getting it at a massive discount, but that's, a lot of that is just because last year, we really focused on building those relationships with lenders. So when that time came, we'd be their first call. And it's really working out for us now. And we're able to actually talk to lenders directly, instead of kind of having that broker as the mediary. And so I think it's just we're at that point where conversations are now being had. And then, you just got to be very careful on the underwriting, just because we aren't at that point yet where rents are going to be going up. So you just got to kind of pencil that in there for at least, 1 to 2 years of stale rent, and then, start to look at a little bit of rent growth at that time.
Yeah, we can't write hope into the business plan just yet, but
that's right.
We went through that period of pretend and extend on the ownership side where everyone knew, okay, we've got debt coming due and, it's underwater. You can't refinance out of it to your principal amount. You can't sell and make any money off of it. And I think that, we're still working through a little bit of that lender pretend and extend, where you see a big difference where the loan balance is significantly higher than what that market value is. Now the lender has to take a turn. And if they haven't done a lot of these REOs and they haven't had some of that pain already, they're going to get a real education in terms of, okay, what are my operating costs here? And what is the market really telling me this is worth? But in cases where they've, this might be their 6th, 7th property that they've taken back, they've already gone through the boxing ring. They're 6 rounds in. They're like, okay, we know that we're going to have to, we're either going to have to take a hit on the principal, or in a lot of cases, we're going to have to put a little bit of money into this thing, get a good operator and, stem the bleed, get the value up and limit the loss. And there's a lot of stuff coming due this year. I mean, we said that last year and we said it the year before. And in most of those cases, they were extending, but we're seeing a lot more activity in terms of things that are actually deliverable and that will trade.
And I will say too, the lenders are being particular on who they're talking to. Luckily for us, we didn't buy anything for 3 years, from January 22 all the way to 25. And, it's funny, we were up on stage at a conference and right before we closed on that property in January of 22. And, we were saying, hey, listen, where the economy's at, the only way to get ourselves out of this is either cut government spending or increase interest rates. And government's not going to cut their spending. So, we projected that rates were going to go up 150 to 200 basis points. People were laughing at us. And although we were right on that there was going to be an increase, we were way off with the magnitude of it. I mean, it went up 500 basis points. But, with us having kind of that foresight, we didn't get ourselves into a sticky situation as most people are. So I think, stuff like that is what lenders are looking for, because they don't want to be in the same situation by just reselling it to somebody who's going to make the same mistake.
Yeah, I agree. Yeah, it was hard to see. And I too felt like, the rates can't exactly stay where they are, but yeah, I had no idea they would go up as much as they did, as quick as they did. And it did catch quite a few people by surprise. So good on you to kind of hold steady there from 22 to 25. That obviously, hindsight's 2020, but that's huge. There's a lot of operators out there that wish that they kind of did the same thing as you guys. So.
Well, and we're being transparent. We didn't think it was going to go up 500 basis points.
Yeah, for sure.
And the only thing that saved us, that deal we bought in January of 22, I mean, that could have been the same situation, but we immediately put a 3-year rate lock on that. I think we paid about
rate cap.
Sorry. We paid about $27,000, and over that course, I think it saved us about $290,000, of interest. And that's the one thing that saved us on that deal.
Yeah. And talk about hindsight bias. What we should have been doing was buying rate caps in 2022 and not, not apartment properties.
Yeah, that's right. And I think kind of going back to the beginning of your story, I think it's really, while not everybody has to do it this way, the fact that you guys kind of did everything from swinging the hammer on up to on that first 6 unit deal, and managing it and having to show the property. I think there's a lot of just, overall business acumen that comes from doing that kind of thing, from learning really, even though it was a smaller deal, right? And, obviously as you scale up, the magnitude of it increases significantly, but I think there's a lot to be said about, just having done that in your past.
Yeah, well, I think you need to have a real curiosity about every part of the business that you're operating in. And, for us, we always want to know everything. And people make fun of me because we'll be out at a property inspection. We were out at one a month ago, and we had a foundation specialist out there. And I wouldn't shut up about asking him questions. I wanted to know what kind of clay the soil was. I wanted to know on a pier and beam foundation exactly how they underwrite the cost to bid it and how every little piece of that works. And now I can walk in and I know that, every 8 feet you're going to have a pier, and it costs about $250 to elevate or, delete one of those things and get it up to the right level. And if you got to dig a tunnel, you're going to do a 3 by 3 foot square. It's going to be another $250 a square foot. They're going to find some small guy that I don't know how they find him, but he's going to dig that tunnel underneath that building. And, if you do that, you're going through your tax return, you're doing cost segs. Okay, I really want to know exactly how the tax code works. If you have a curiosity in every part of the business, then you're just going to be a better operator. You're not going to see everything that's coming down the road, but you can't outsource all of your thinking and understanding to other people. If you have a little bit of everything inside of you, then you can go do, because oftentimes we'll go look at a property and we have to, perhaps be the winning bidder, put $50,000, $100,000, $150,000 non-refundable on day one. And Erik and I have been through thousands and thousands of units. We have been through hundreds of inspections. We used to own a construction company. Like, we can go through there. We're going to hire an engineer, but we can go through there. We can tell you all about the framing, the electrical, the plumbing, the roof. I mean, we know.
Yeah.
And we've avoided some mistakes. And on the finance side, I mean, we can dig through a T12 and, kind of pick out differences between cash and accrual. But I mean, we couldn't have done that at the beginning of our career. You learn a little bit along the way and you just stay curious.
Yeah, for sure. WealthFlow audience, pardon me for a quick interruption to today's show, but I have some exciting news that I want to be sure that all of our listeners are aware of. We just launched 3 totally unique to the market funds that are at the cutting edge of technology and AI. We have combined my 25 years of real estate experience and my recent work as VP of development for a tech company to bring 3 awesome investment options to our audience. For full details, go to our website at bobocapitalventures.com. Again, that is BOBOcapitalventures.com. All right, back to the show. Tell me a little bit about geographically where you're investing, and I'm sure that's changed from the beginning to today. But if you could kind of take us through where you're currently holding properties from a geography standpoint, and then where you're looking right now.
Take that.
Yeah, so we started in Washington State. Like Erik said, his first deal was December 2007. Next one was February 2008, and the market up there, obviously, we went through the Great Recession. Coming out of it in 2011, 2012, it was a great market. You had the constraints of kind of the geography of the landscape in Washington, so you couldn't really overbuild just because there wasn't space for it. And then you also had the tech companies, white collar jobs that was fairly easy to rent. As legislation and regulation started changing in Washington, it really just didn't match with our business model. And that's in 2018, we realized our runway wasn't up there anymore. So we did about a year of research, pretty much every major metropolitan area in the country. We came down to Florida and Texas. And then so the next year we spent that, next year going down to both places, looking at properties, building relationships with brokers, with lenders. And then in 2020, we bought our first deal in Arlington, Texas. There was a lot more opportunity and deal flow in Texas. And then in 2021, we knew our runway was here. So we ended up moving our families down here. And then just, we started selling stuff in Washington around 2018, 2019. We've got our last deal on the market up there. We're so heavily involved up there just because as we were selling, we got a lot of interest in third-party management. And that's kind of how our third-party came about. And so, we still manage about a little over 1,000 units up in Washington, but, our runway and syndications here in Texas.
Yeah. And it was a fun project. I mean, when you stop and you say, okay, where do we want to spend the next 30 years of our career? Because, at that point, I think we were in our late 30s, just about to be 40. It's fun just to start with, okay, how do we decide? How do we decide what market we want to go to? So we were looking at, okay, well, what's the overall demographic move? Like, where is not just going to be the hot market for the next 2 to 3 years, and we don't certainly want a flavor of the month market. We want something that we can get deep into and we can spend 30 years there because it's such a relationship driven industry that, we're leaving 20-year relationships with brokers, title officers, lenders in Washington. We have to create that in Texas. So we were looking for where are people moving to, where are jobs moving to, what has a long-term regulatory environment that we want to operate in, and then what is a big enough market that we don't have to go buy properties in DFW and then say, oh, we don't see enough deal flow. Let's go to Oklahoma City. Let's go to Kansas. Let's go to Denver. Because we want to be very deep and very focused. At the time, there was about 700,000 units in the DFW Metroplex. I think we're closer to 1 million today. That's plenty for Erik and I. There's enough deal flow that if we draw a circle about an hour and a half outside of our personal residences so that we can still drive to properties, that's where we're going to be focused on for the next 2 decades. There would have to be some major black swan event that all of a sudden Texas is just no longer a viable place to invest, because you're going to see ups and downs in every market. But if you know the market very well, you know the neighborhoods, you know all of the people that are players in that industry, and then in those downturns, you can turn it into moments of opportunity. And that is exactly what we were trying to do. And so we're here for the long term, and our families love it. We love being Texans. It's fantastic. And that's kind of how we decided, and that's where we're going to stick to on the syndication side.
Yeah, sounds good. Not a bad spot. So you're both living up in the DFW area then, and couldn't have picked probably a better spot. As far as Texas goes, it's good. I'm in the San Antonio area. I love this area. I love Austin. Grew up in Austin area, but you do Austin, San Antonio. Call that the new Dallas Fort Worth. You got Fort Worth. or DFW, and then you've got Houston, and between that big Texas triangle there, you can cover a lot of bases. So that's awesome. What your property management? You still have 1,000 something units that, or not units, but doors that you manage up in Seattle.
Correct. Yeah. So we still have about 1,000 there. We're pulling on another couple hundred here next month.
Okay.
And the thought there was, well, we've always been owner operators. I came out of the Great Recession as a necessity because I needed to figure out how to make $1,300 a month and feed myself. And that was my property management fee.
Right.
But, as we grew the portfolio, we tried a couple times with other operators and we just couldn't get the result that we wanted. They weren't bad people, but they just weren't invested in what we were doing. And Erik and I are very particular on, wanting to keep costs down and being aggressive in terms of unit turns and rents and timelines on renovations. And we don't want to spend a lot of money. So we always got a lot of feedback from brokers. Hey, you guys should do third-party management. And when we looked into it, we said, gosh, it seems like a lot of work for not a lot of money. So let's not do it. But as we were selling everything in Washington, we had some great people working for us, people that have been with us since 2012, 2013. And if we sold everything and just picked up and moved to Texas, they weren't going to come with us. And they have families that they need to feed. They're good people. So we said, okay, let's dabble. Let's try it. Let's just take on, a small 16 unit. This was right as COVID started in Washington, where it was a complete lockdown. We could not physically show units, so we did the whole thing virtual, leased it up, set records and rental rates, and then all of a sudden the brokerage community took notice that, okay, well, we're not buying, we can do really good things for their clients. And so all of the growth that we're going to be having on the third party side and that we have had, it's all been referrals from people that said, hey, we like the way that you did this project. Can you help our client out here? And then we meet great owners that are just become friends of ours. And so we're going to keep growing that. The reason that we do it is that we get the economies of scale. We get the leadership team. So we have the controller, we have the president, we've got the marketing person, the facilities director, all the support staff to help us operate our portfolio better, that really we wouldn't have been able to have the income to pay for all that staff if we had just been very slowly buying 1 to 2 deals a year as we found great opportunities. So it gives us a head start in terms of giving us the capacity to operate better. And that's why we do it.
For your own properties in particular, there's going to be a huge alignment. And I think honestly, for even the ones that are relying on you as their third party property manager, an operator that has facilities, that understands the perspective of the landlord, that understands that, hey, look, I know we've got this leased up and maybe the average time on the market is X before we get a renter, but that's not how we do it here. We have a sense of urgency about it. We want to we don't want to miss a beat here. So that's great.
We do a morning meeting with our entire leadership team, and if any property is under 97% vacancy, that property is on the docket for the morning meeting. And I mean, we could tell you exactly how many guest cards we need to get. We can tell you showing, conversion ratios, and we have all of that data, and we have very strict guidelines on what our managers need to do to treat those guest cards good. Everything from vacancy, delinquency, expense control. I don't think the secret sauce really is in so much the strategy with operations. I think it's in the execution. You have to find a team that's willing to do hard, repetitive work on a daily basis and find some kind of joy and camaraderie in it. So it's very much a cultural thing, and that's hard to outsource.
Mm-hmm. For sure. Well, tell me a little about the types of properties that you're looking for. What class apartment complexes are you purchasing, and kind of what's the strategy behind it from an investor's perspective?
Oh man, we are like the Statue of Liberty. Give us your tired, your poor, your huddled masses. I mean, we want we want the Like anyone, we would love to make a lot of money on Class A. We just can't usually make it pencil. We're not going to be competitive. So we're typically looking at either 60s, 70s, 80s vintage, tired properties that either have operational problems or they've got some deferred maintenance. The finishes are a little obsolete. If this will be our 18th project, and let's see, 15 of the projects we've done have been all bridge loans. So it's really been value add type investing. Occasionally we'll find something where there's just true organic upside in the rents and they weren't charging enough, but that's very rare. Usually we have to do something to force that appreciation and that cash flow. In this particular cycle, I think a lot of the people that were buying 60s and 70s, they have moved into the 80s product because it's a nicer product. Less things can go wrong in terms of systems on the buildings that they own, and there's less competition in the market. And we're looking at it and we're saying we have a huge team of great contractors that need work. We can do things way cheaper than retail, and we know how to fix these issues and cure deficiencies. So the best opportunities we're seeing are typically 60s, 70s product that have a lot of hair on them, and we can get it at a steep discount. Now, if we go, we've bought properties that were built in 2015, 2007, early 2000s, and we love those. But we can't depend on those girls showing up to the dance.
Right. I understand. What about from that? You mentioned having a reliable team to do these rehabs. Are you doing anything that to help ensure flooring, carpet, paint? That you've kind of got a reliable calculation where you can update and refresh these units, in a reasonable price point.
Yeah. So, in Washington, we were there for so long. We had a good handful of vendors that we used. And we've always, kind of looked over the project management side of things. And so we've tried GCs in the past, and then, they're obviously charging a 10 to 12%, project management fee. Then they also increase the cost of materials, so they make extra money there. But we're still having to oversee it. So, early on, we decided, hey, let's cut out the GC. We've got relationships with these vendors, and so we can just act as a GC and make sure that we're not getting overcharged. When we moved down to and down to Texas, that was our first goal. Is we're like, hey, we've got to build these relationships with quality vendors that we can trust. We not only trust with doing quality work, but also trust giving us a fair price. And, part of that too is just us leveraging them against each other. Every time we have a deal, we know exactly what we need to, what our cost is on each unit. And, we put all 4 to 5 of them up against each other on every deal and just say, hey, here's our budget. Here's what we're looking to do. Who can come up with the best cost? And we do that because we know, we've worked with them for years now. We know their quality of work. And so, that's no longer a question, but we also just keep it fair on our end, just to make sure that nobody's starting to hike up prices because we keep them in competition with each other. So now we've got enough projects where we keep them all busy, and they've all been fairly, good on pricing. Every once in a while, somebody will start to jack up their price, and then we stop. We're not giving them as much work, and they're like, all right, we need to lower our price again. But, I think the key on that is, treat them well, make sure you give them enough work, but also make sure you keep them honest and competitive with their pricing.
Yeah. No, I believe that's wise. I think it's okay too to let them know why they missed the deal. I mean, they're not always receptive.
Master.
I'm sure you do. Yeah, they're not always receptive to that feedback, right? But it's something they need to hear. And I when I've done that in the past, it's been like, it may take a day or so where then they'll come back around and be like, you know what, I appreciate you letting me know that, because they don't want to miss the next opportunity. So.
Well, what's fun for me is Erik and I share an office. So he's in one corner, I'm in another corner. It's another thing people make fun of us for, but we just like being in the same room. And so I'll come in and I'll be working on something and I'll be listening to Erik negotiate these vendor contracts. And he will have, like, when we go do a walkthrough, like we just did a walkthrough of a property, he's got a spreadsheet where every column is a different item where you got all your usual flooring, cabinets, appliances, all that. But I mean, it goes down to the detail level of, are the door handles uniform? How are our switch plate covers? And he will assign a cost to what needs to be replaced, what we can keep. And so he's just going through these bids. He'll send that to the contractor. And like, no, that switch plate cover only cost $1.29. I don't think you can bill us for $5. And it's
Yeah.
beautiful. I mean, it's an absolute
That's
work
great.
of art, and I love it.
That's fantastic. How about from a property management standpoint, what kind of systems are you utilizing there to kind of help operations, work as well as possible? I'm sure, most folks have their tenant portals and that kind of thing, but and maintenance requests and whatnot. But what systems are you utilizing from a technology stack to kind of help?
Yeah, we use AppFolio as kind of the main hub for
Okay.
CRM, accounting, all of that.
Investment platform.
Yeah, we use it for the investment platform as well.
Yeah.
When we're raising money, updating investors. Now they have a lot of different stack integrations that will bolt on, that will help with various things from accounting, procurement, purchase orders, all of that.
Marketing.
Yeah. But we're constantly tinkering. I think the big one that, we are testing things out on all the time right now is all the AI tools in terms of tenant communication, lead nurturing, all of that. And we typically will test it out on, one property. And if it works, we do more of it. We expand it to the whole portfolio. We've had hits and misses on the AI. I mean, the potential is undeniable for what it can do. But in some cases the technology is not there yet. So you have to be very careful, because when a tenant is on their lunch break and they're looking for an apartment, they can get that immediate robo text, "Hey, would you like to schedule a tour?" But then you go look at the downstream effect of that and you realize that they're getting 6 of those from every property that they're inquiring for on their lunch break. So what's going to separate you? An actual phone call. And so now you're looking at, from a systems standpoint, you're in your software and you have timestamps where you say, okay, there's a half-life in terms of how quickly we get back to somebody. Once we hit over an hour, they're 50% or whatever the number is less likely to show up. And that's your biggest metric. Once they're on property, it's just application, approval, lease. And, we're very good. The biggest drop off is, portfolio wide, we might have, 40,000 guest cards in a year. And then all of a sudden 3,000 people showed up to view an apartment. If you solve that number, then you don't have an occupancy problem. So if the AI can get to the point where they have realistic voice capabilities, which is almost there, and we're about to test out a new product that has that, where you can have a conversation and a phone call, even if the tenant knows it's AI, but they can answer the questions that they have. Hey, do you accept pets? I've got a ding on my credit score. Is this going to disqualify me? Those types of things. And then you can do the lead nurturing. Then it can be a game changer. I just haven't seen it actually happen yet.
It's getting
to where it's better than just beating on our property managers every day that they have to pick up the phone.
That's right.
But yeah, everything else
great.
is online. Yeah.
Okay, perfect. And I guess tell me a little bit about kind of where you see Iron Ridge going. If we were to look out, we're right, in kind of the beginning of 2026, but over the next 3 to 5 years, what do you anticipate, and what do you hope to happen with Iron Ridge Capital?
In terms of the next 3 years, we'd like to take the model of buying 1 to 2 properties a year and up that into 3 to 5 a year. Of course, we would love to do 10, but you're limited by your ability to do a good job. With where our team is at, we have to, be able to digest whatever we swallow, bite off, however you want to say it. So be very aggressive on the acquisitions for the next year and a half, 2 years. But Erik and I, we don't have any Learjet ambitions, or we're not going to be the Grant Cardones of real estate. We've built a solid machine that if you have responsible growth, and we don't screw up anything, we're going to be just fine in retirement. So we just want to have responsible, immediate, aggressive growth. And then as all the players kind of re-enter the market, that euphoria comes back in. You get the new kind of syndication groups trying to make a name. We're going to sell everything that we're buying to them over, everything we're buying now, we'll sell to them in the next 2 to 3 years. And then we'll just, kind of be choosy. On the third party side, in 5 years, we'd like to have 10,000 units. And if you map out what that looks like in terms of the capabilities for operations, I think it gets us to a place where Erik and I can focus a little bit more on the strategic, and that's fun.
Yeah. Well, that's great. And I think that's a smart growth path. I mean, you're increasing it from where you currently are, but like you said, I mean, some people hear how many acquisitions a lot of times just in interviews, that they're doing in 1 year, and I'm thinking, how, especially if they're trying to be vertically integrated on the property management side and everything else, it's a lot of acquisitions. And how are you going to grow your team quick enough to be able to really not miss a beat and get a little sloppy with, kind of trying to take all these under one roof so quickly?
Yeah, there's a real art to a handoff in terms of duties. And, when it was just Erik and I sitting in 2 swivel chairs, you hire that first employee and you have to train them to do a task for you. So as you grow, taking the time to truly download what's in your head, what your expectations are. We always liken it to like Navy SEALs. You're going out on a mission, and everyone needs to understand their job, and it's life or death if one person doesn't do their job. You are depending on that person to hold their corner. We look at it in the same way in our company. We need to take the time to have the reps, to do the training. Do you understand the assignment? Can you demonstrate to us that you understand it, so that we know that as we're off over here, that duty is being taken care of? That takes time, and it's a real investment. And we know that in this industry, we will not have any mulligans. Our group of investors, Erik and I, are not mega networkers. We don't advertise on the internet. These are people, our investors are mom, dad, the people in our wedding party, repeat investors that we've grown organically. Now, that group has gotten quite a bit bigger, but we try to know everybody. And if we screw something up, we're not going to have a Thanksgiving table to sit around.
Right. Yeah, or it'll be extremely awkward.
It'll be very awkward.
So, no, that's great. How about market in general? Where do you see the market? I know none of us have a crystal ball, but I always like to hear, you guys have been doing this at this for quite some time. Just curious on what your thoughts are as to what's going to happen over the next couple years.
I think that there's a lot of predictions that with a drop off of supply, with roughly half of the incoming units that we have, that we're going to see rent growth in 2026. I don't think that we're really predicting that in the DFW market, just because we've also seen a real reduction in immigration rates and we've had a lot of deportations. So you have to weigh all of that together. I do think that we have great job growth. The fundamentals of this DFW market are very sound, and we still have a lot of people moving in. The absorption has been fantastic. And then by having our fingers on the pulse of the market, we're always looking for forward-looking indicators on where rents and occupancy are going, and they're headed in the right direction. So if we know that those forward-looking indicators are pointing up and to the right, then we feel good about where it's going. We do not underwrite to higher rent levels. Like right now, we're currently underwriting 0 rent growth for the next 12 months. Past that, we're underwriting a 3% rent growth. I think there's a lot of macro headwinds that we have to deal with. We've got debt issues, and I think that it's, we've got, all sorts of geopolitical stuff, and then we have AI. And, I think AI is probably going to be, it's the biggest concern that I'm constantly trying to figure out in the back of my head. What happens to the workforce as that is implemented? I feel like we're less exposed when we're doing Class C workforce housing. But we can start to see it in some of the properties we have in Seattle, Washington, where Amazon lays off 30,000 people. and all of a sudden you see a vacancy spike in a Bellevue property. Now, every time we've had a technological advancement, we have new jobs that are created, and I'm hoping that we get to the same point. But all of our assumptions include that interest rates remain relatively flat. We're not hoping that they go down. I could see that happening. I mean, if we can keep the petrodollar in a good place, which I think that we've seen recent actions to do that, then I think that you could make a strong case for a flight to safety and better treasury yields. But then you also have to tackle the debt issue. So we're all over the place. We're macro nerds. I could rate you at the assistant either way. You tell me if you want it to go up, you want it to go down. We'll tell you. We're kind of holding everything steady.
Well, I think there's a lot to be said about that. It's hard to tell for sure. You're right. If you lean into one side or the other, you can make a great case either way. I think not anticipating rent growth in the first 12 months, I think is probably wise, at least from an underwriting standpoint. Hopefully that will change, and you'll start to see it, and 3% the following years, not a bad assumption either. So, well, this has been good. How can people find out more about you guys, Erik and Iron Ridge Capital?
You can go to ironridgecap.com, and Erik and I are super old fashioned. We like actually talking to people. So our phone numbers are on there, and we like to get to know everyone. So it's one of those, we're kind of rare. When I got married to my wife, I told her that if it's a broker or an investor outside of our wedding and the birth of our children, I will pick up the phone. You have to be on board for that.
Yeah. No, that's...
And we like it.
I like that too. It's a personal touch, and it's nice to have somebody that still does pick up the phone and answer your questions. This has been fantastic, guys. I have two other questions for you that I ask every guest. One would be any advice you would give somebody who's maybe a limited partner, they're just starting out in their investment journey.
I think you need to go, if you're starting your investment journey, if you're young, it's not how much money you put away, it's that you start early and start that compounding. For the knowledge side, I think that if you're going to be in the business, you need to either be a broker or you need to work underneath somebody that is doing it at a high level. Treat it like an apprenticeship. And before you take any capital from anyone ever, you need to do something on your own, because you learn through failure, and you need to fail, and you need to do it with your own money.
Yeah.
So go buy a small property or whatever it is you're doing. If you're a startup, do one on your own capital, borrow some money from mom, but learn your lessons with your own money and then scale.
I mean, I would agree. I think obviously, buying the deal at a right price is important. I think more importantly, it's the operations, because the operations are the one thing that can get you out of trouble. If you know how to do it well. And, here in Texas, when we moved down here, Texas is very big into educational groups. And, the educational groups were great for getting GPs, LPs together, combining somebody who wants to buy a deal with somebody who wants to invest in a deal. They tell them how to underwrite a deal. They tell them how to negotiate a deal. They tell them how to buy a deal. What they didn't tell them is how to operate the deal. And that's why we're seeing a lot of people in trouble right now, because that is the most important part. So, kind of extending on to what Erik said is, you're going to have to go and do it yourself. Go start small. You don't have to start off with a 100-unit property. Go buy a 10-unit property. Do it yourself. Do every aspect of it. Or if you're not doing every aspect of it because you don't know it, learn it. Hire, but be there when they're doing it. So you have to understand that. And, I think that the best advice to, everybody wants to do, a get rich quick, concept, but those are very rare when they succeed. And if they do succeed, it's not a long-term play. The only way you can make it a long-term play is fully understanding the operations of things. And the only way to do that is by doing it.
And real estate is not a get rich quick industry. I mean, it is a very long game.
Yeah. It is. I always, I've been in it quite some time, and I've always thought, man, when is this going to happen? But eventually you start to look behind you and you say, you know what, I have built something here. And, but it doesn't happen overnight. So that's awesome. How about a book recommendation? Doesn't have to be real estate or finance related, but it certainly can be something you've read that's been impactful though.
I'm reading the Charlie Munger Almanac right now, and it is absolutely fantastic. I mean, the architect, the guy is one of my heroes. I wasn't expecting it to be illustrated, which adds a little bit of fun to it. But I've got that one, and then Meditations by Marcus Aurelius is next on my list.
Yeah, fantastic. How about you, Erik?
I don't really read long books other than the Bible. But I will say, one of the books that really stand out that's helped me in just the managing aspect of managing of people is the 1 Minute Manager. I've read that thing over and over again. When I was back in the fitness industry, I read that for the first time. I found so much value to that book and I implemented it immediately. I then had my leadership team read it, and I've read it multiple times over and over again over the last, 25 years. And I think that's been an inspiration just on how to manage people and get the best out of people by letting them do what they do best.
I agree. That's a great one too. All right. Well, fantastic, guys. This has been a lot of fun. I appreciate you being a guest or being guests on the Wealth Flow. Thank you so much.
Yeah. Thanks, Heath.
This is super fun. Yeah. Thank you.
Thanks. All right. If you're still here, I assume that you found value in today's show and with the guests we interviewed. Please take a minute to subscribe and to review the show. It really helps. Also, wanted to remind you to check out Bobo Capital Ventures to get the first look at our 3 new cutting-edge, first-to-the-market investment opportunities. We have only about 15 spots for each fund for retail investors, and we would love, more than anything else, to have our audience be part of that group of limited partner investors. Thanks for listening to The Wealth Flow, and have a great day.
Being that you're still here, I trust you found value in this episode. I personally wish I would have known these guests and strategies when I started my wealth creation journey. Go to wealthflow.capital to subscribe to our newsletter. And as a free gift, we will send you our quarterly market report and the top 10 things to look for in an investment opportunity. Take a minute to give our show a rating and review. Help us reach 1 million professionals by subscribing and sharing this episode with someone you know who could also find value in it.